The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the show. I'm Victor McClure. I'm your host and the president of the Dillon Gage Wealth Management Companies. For those of you new to the show, we developed this show to answer your financial questions. So many shows, it's just a sales pitch on coming to my next seminar, or they might give one nugget of information that you can't use unless you come to the seminars and all this kind of stuff. This is information you can use right now. Obviously, we hope you'll do business with us, but either way, you listen to this show, you'll always learn something that you can use in your financial lives. My co-host, Guy Allard, how you doing, Guy?
Pretty good. What's going on? I was going to mention also, a lot of times, teasers, you get partial information. You don't get the whole thing. I was talking with a client today and asking about her stock being in the market, and I said, well, that's only a partial deal. You've got a whole diversity of things. You got the bonds. But I did want to take a minute and let our listeners know. I know a lot of our listeners listen to the whole show from beginning to end, and we've never really been able to make this available to them. And Victor's kind of looking at me. I didn't warn him. But I wanted to finally have the opportunity to make available to our audience the opportunity. We have a window where we are accepting new clients. Probably for the next 2 or 3 months, we have room for some new clients. Victor and I both would love to work with you.
I was wondering where the hell you're going.
I don't know.
I was thinking, what is he going?
Do you have room for a client or two?
A couple.
All right.
Yeah.
Well, we have room. Call us.
All right. Today we're going to talk about our retirement analyzer, retirement stress test, Social Security optimizer. These are things we offer complimentary to all of our KRLD listeners. It's not the normal. It's a lot more in-depth than other analysis that you might have seen. A lot more in-depth than something you can get online. And even for your do-it-yourselfers out here, these things take into account so many different things that you might not have thought about. Everybody does simple math in their head when it comes to finances, especially if they do it themselves. Every once in a while, I'll find an engineer or two that will give some compounding stuff. They're still not doing everything, like the taxation of the withdrawals from their 401ks or the required minimum distributions. They're not doing everything, but they're doing more. But think about it. Let's say you've got $3,000 a month coming from Social Security. Your bills are $6,000. All they do is say, all I need is $3,000 a month. All right, how much do I have over here? $1 million that will take me 30 years. Fine. But they've missed one crucial thing. They forgot to factor inflation. Just because your bills are $6,000 a month, they're not going to be $6,000 a month 10 years from now, unless you can somehow tell the water company to quit raising your rates on water, the electric company to quit raising their rates, Medicare and all that to quit raising its, deductibles, rates,
and even simple things when you're trying to scratch it out yourself or do it on an Excel spreadsheet. Met with a client not too long ago. Mortgage was X amount, and 3, 4 years, 4.5 years, it was paid off. So you can mark that down. It shows the expense for the remainder, 3, 3.5, 4 years, whatever it is, and then it comes off. And that's just one example, but we can put all of that on there. One pension, I've got clients that have multiple pensions. Lucky them, right? One will start at 62, one won't start till 65, so you input that. I mean, it just really gives you clarity.
Remember, this sounds like an obvious answer, but remember, when you're paying off your mortgage, you still got to pay taxes and insurance. And those things still have to factor inflation in them until you're 65. Because in Dallas, they'll freeze your taxes at 65. But you still have to look at those kind of things. I don't know if that is throughout the country. I know it is around here. But you've got to make sure that you've got an increase in those taxes. And because your valuations are going to keep going up, taxes keep going up, hopefully anyway.
It was a principal and interest number,
right,
obviously, that we removed.
It's weird how those municipalities, when the the real estate market crashes, they'll lower it a little. It's not anywhere near their actual valuation.
And think about it. When your expenses go up, your income's going up, your pensions, your 401ks, your RMDs get larger perhaps each year because it's required. your tax bracket changes. So all of these moving parts are handled in the software. Again, it really gives you clarity.
Yeah, it's there is so much more involved. Like Social Security is taxed at certain rates depending on how much income you have coming in. If you get the maximum, it can be taxed as 85%, but there's a 50% threshold, an 85% threshold. There's different required minimum distributions based on. That's when you're 70 and they make you spend down your retirement funds, like your IRAs, 401ks, all that kind of stuff.
And it can start sooner than 70 and a half if you have an inherited IRA.
Right. So, and that is a way for the government to get their tax money. Because if you just died and left this to your heirs, which are younger than you, they'll never get their tax money. So they're going to make you spend your money at 70 and a half. It's actually April 1st, the year after you turn 70 and a half. They're going to make you spend down your retirement accounts or your qualified accounts. They'll increase the amount you have to spend every year. Now, if there was a static amount in there, you could never deplete it because it's always a percentage of what you have left in there. Taking losses, though, you can deplete it with losses, of course. And so be real careful with, retirement plans, because a lot of people say, I've got this $1 million IRA. I want to leave $1 million to heirs. It is not going to be that easy. It's going to be extremely difficult to keep that together.
Based on what, a 4% withdrawal or something, you think?
Yeah, it starts at like 3.5, but it keeps going up and up.
No, but I mean,
80s are making you take a bunch out.
That's right.
And there's no way you can keep up. I haven't seen it happen too often. I'll put it that way. There are things you can do beyond that, because when you're leaving your relatives or heirs a lump sum from a retirement account, it's taxed. It's not very tax favorable.
No, but what happens is, obviously, if you're very fortunate and you're a very good investor and your interest is equivalent or exceeds what the required minimum distributions are, then, of course, you can leave that whole corpus to your heirs. But That's tough in this day and age.
So let's talk about this. Now, remember what we do is this. We take a portfolio, okay? We're going to get input all your numbers. What are your income? You and your spouse's income. What is your Social Security? Because we're going to run a Social Security optimizer on this. We're going to put your normal one in there. Then we're going to have an optimized income strategy that's going to show if you just tweak Social Security like this, it'll pay you an extra 30% lifetime or something like that. I've seen it up to $500,000 more in lifetime benefit by this program showing how to optimize your Social Security. So we put those things in there.
A lot of the subtle things. A lot of us will look at our Social Security at 62, at the full age, 66 plus a few months now, depending on how old you are, and at 70. And you look at the difference from one payment to the next, $2,500 or $3,000. But there's a lot more that the program shows you. You're aware of it, but it's hard to really grasp it all. So if you wait from 62 to 66, yes, you've got that increase in Social Security, right? But you've also worked 4 more years. So you've preserved everything for 4 more years. So there's more moving parts that, you're aware of, but it's kind of hard to define, and this will do that. If you work to 70, you've worked 8 more years.
See, to me, it's hard to find. There's we've always tried to tell you to separate your emotions from your money. It's very hard to do, extremely hard to do. It might be easier to separate your emotions from politics or religion. That's how hard it is to separate emotions from money. But if you can, I'll give you an example. Social Security, most people take it early. Most people, it's kind of the bird in the hand mentality.
They're afraid, they're not going to get it.
It's not going to be there for long. What if it goes bankrupt? At least I got some of my money back, blah, blah, blah. But the truth is, they're probably going to keep Social Security forever. They may tax working people to death, but you'll be all right as you're retired. But there's so many. If you see it in writing, say if I live to 85, my wife lives to 87, oh my gosh, we gave up $400,000 by taking it early. $400,000.
And each additional year you work, you're usually contributing to another retirement plan as well, right? A 401k, an IRA, so you've got that too.
But even if you retired early, delaying that Social Security makes quite a bit of a difference later. And I'm telling you, I know it's an emotional response. People that want to take Social Security, they don't want to hear any kind of logical reason you want to delay it, because you're part of the system now. You're part of the Wall Street machine that wants me to delay it. I don't care when you take your Social Security. That's your business. All I'm trying to do is show you the math. Remember, the math never lies. People, your emotions can lie to you or shield the truth from you or whatever.
Kind of counterintuitive, but think about it. Sometimes also deferring a little bit, waiting to get Social Security, and using other funds, maybe even non-qualified funds, will still give you, which the program will show you, much more in retirement and more non-qualified funds. It's counterintuitive, but you've got to see it in black and white.
I see a lot of people say, well, you make me a plan where I die with $1 because I don't care about anybody else
right.
getting anything. Die with $1. And I said, the only problem with that is, what if you live one more day? It's one more day. You're living. You're like, well, I don't know what we're going to do because it's cat food tomorrow. We already did the plan. We're broke tomorrow. I can't do that. So what we do is assume you're going to live a long life. And if you live a short life, you're going to have a lot left over for your heirs. You can't assume you're going to have zero. Don't get me wrong. I'm like I told all my kids, 4 of them. Kids, you're welcome to every dollar I don't spend. Just hope I'm not a burden on you.
That's right.
all I can. Remember, if you'd like to take advantage of our retirement analyzer, retirement stress test, and Social Security optimizer, don't hesitate to call our hotline, 972-715-2424.
And we are accepting new clients.
That's right, 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. We're talking about the benefits of our retirement analyzer, our complimentary service to all of our KRLD listeners. Now, if you're 25, it's a little too premature. But 45 plus, it can be a real benefit to you. Remember, there's no cost, no obligation. And we run the numbers because it's very difficult to really get a grasp on what is your life going to be like when you're 65, 75, 85. This will give you a good grasp on it. It'll put inflation in there. You know what inflation's been for 100 years? About 3.3%. What has it been the last 40 years? About 2.5%. And I don't really care what happened in 1920. So the last 40 years is probably where you're at.
And I want to mention, too, jump in there, the sweet spot. If you're between 50 and 60, it gives you a little time to defer and plan as you get into the Social Security years, being 62, 66, 70, whatever your number is. But again, in any age, obviously, in the 60s, we can help, too. But if you're between 50 and 60, you're in a great position to take advantage of it.
What it does, you put your income in there, and if you have any, like sometimes people get a raise of 3% every year. Let's say you're putting into your 401k, then you put that in the program. Let's say your company matches a 3% match or whatever. You put that in. Let's say you get a ESOP plan, employee stock ownership plan, where they give you stock here. You can put that in the plan. But it takes care of all of those different things and the taxation of those. The only thing that's a variable is if taxes go up, as you get older or something like that. And sometimes, I get it, I think taxes are going to go up. But for when you retire and you don't have a paycheck coming in, it's probably going to go down for you. And that's 99% of all human beings. Since they don't have a paycheck anymore, they actually have less earned income. Therefore, their taxes are lower.
Unless, obviously, you've got a tremendous amount of assets and
if you're in the max now and you're going to be the max then, that's when Roth IRAs, Roth 401ks make the most sense.
Good point.
Because a lot of people think that, no, a Roth is tax-free. That's always better than taxable. It's not. If you do the math on it, which I'll be more than happy to do for any of my listeners out there, a regular IRA, mathematically, if you're in a lower tax bracket of retirement, is much better for you than a Roth IRA, taking taxes out now at your higher income numbers.
Yeah, and the difference being, obviously, if you're on a Roth, you're not forced into required minimum distributions at 70.5, and so there's some different things going on. But
there's some benefits to a Roth, definitely. But as far as mathematically, how much you end up with at the end, believe it or not, regular IRAs end up with more most of the time. I'd say, what do you say, 90% of the time? It's up there. All right. So they gather all your information, put all your accounts in there. Now, you have to assume some kind of return, right? But you don't want to assume 10% a year. I've seen this happen at the big brokerage firms all the time. Well, we put it in this balance fund. This balance fund has never done less than 8%.
The S&P's averaged 12% a year for the last 100 years. Come on, man.
Yeah. You can't do that. Right. Because remember, taking money out when the market goes down, it's a death spiral. It will automatically, your plan's wrecked.
Well, withdrawals, just on a numbers basis, withdrawals mess up averages.
That's right. Think about it. You got $1 million. You're taking out $50,000 a year. Market drops 50% like it has twice in the last 15 years. You got 450 after 1 year. I don't care if you make 10% a year every year after that. You cannot catch up. It is impossible. And so that's why if you have prolonged like 2000, 2002, where it was 3 down years in a row, it's a death spiral you can't get out of. So I don't care what some average tells you. So what is a logical thing to put? Well, what we'll do is we'll put 0 on it. From 2000 to 2010, effectively, the market didn't make anything. So that's illogical. It can happen.
And the school of thought is you plan for the worst, but you expect the best.
That's right.
Anyone, if you're making 10% a year, right, or a 12% average, you almost don't need a plan.
Right.
It will work. You're going to have a good retirement.
Right.
Life is going to be good for you. What we want to do is stress test it so we can make sure.
Right. Because think about this. If you can live with the worst case, that's what we're going to do. If you got a plan that's based on the worst case, in other words, you will never go broke till you die. You will leave money to your heirs. Whatever you want to do, it's done as your worst case. Then you surely will love the average case. And you're really going to fall in love with the best case, right? So no matter what, if you know you have planned for the worst, everything else is going to be gravy, and your retirement is going to be that much more, fulfilling.
And one of the things that we talk about clarity and what the plan shows you, it'll show you how much you'll need to take care of your income, how much you can have in the market, how much you should have in bonds. If you've got a ton of money, chances are the amount that you'll need to set aside for a guaranteed income, maybe $500,000 out of $2 million. If you only have $500,000, it's possible, depending on your lifestyle, you may need $400,000 in a fixed income, but it varies. But this will show you clearly.
It shows you the allocation. It'll say, all right, I'm a 62-year-old couple. How much should you have in stocks? How much you should have in fixed income? It'll tell you if you're overly aggressive or not aggressive enough. It will show you those kind of things.
And the important thing I want to emphasize, once you have, Victor and I talk about it all the time, the fixed income handled, it allows your stocks to be unburdened and you're not stressed. You don't have to pull out when the market's going down. It actually allows them to do better, right?
And then you got your expenses. It's going to take into account all your expenses, and then you're going to add inflation to those expenses. Unfortunately, like I said, your groceries are going to keep going up. So is your electric bill, water bill, blah, blah, blah. And so you have to account for all of those kind of things. Do you think health insurance is going to go down?
Oh, absolutely. We've got Obamacare.
They just said Obamacare now. They want an average of a 57% raise.
Oh, the insurance companies are pulling out because they're going broke on the plan.
Like, this isn't working. But don't hesitate to call us. We'll talk more about this after the break. But if you have any questions, like to take advantage of our retirement analyzers and stress tests and Social Security Optimizer, don't hesitate to call our hotline 972-715-2424 or go to ilovemyretirement.com.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Today we're talking about our retirement analyzer, retirement stress test. It's actually a retirement plan that you can have. It's a written retirement plan that you can use. So many people just wing it. They think, well, I've done okay so far. I don't think there's anything I haven't seen. I'm 65 years old now and blah, blah, blah. And I've seen it for over 30 years we've been doing this. And I've seen so many times that people thought they were doing the right thing, and all the information that they had given to them, they made logical decisions, and it didn't work out.
I was going to say the same thing. We've seen a lot of clients come in. Well, basically you guys, our listeners. And they've got a plan in mind. They've done a real rough estimate. They know the difference between taking Social Security at 62, at the full age 66, at 70, all that stuff. Know where the bills are, what they're going to stop. But when they actually look at this, when it goes through the filters, we give a little stress test to the stocks that are at risk, put a little inflation in, and take care of all of that. Things change. And when they leave, I mean, it's a big relief for them. They're very happy.
And what people do is they fail to put in their real expenses. What they'll try to do is they'll think about their hard expenses, like mortgages, car payments, stuff like that.
Leave out entertainment, perhaps?
They'll say, hey, I'm only spending $5,000 a month. Then you actually get a spreadsheet of what is outflowing every month, and it's $10,000. And this happens all the time. So
it never goes the other way, does it?
No.
Never less.
And they always say that you should have, 75, 80% of your pre-retirement expenses?
Not anymore.
That is not my, I haven't seen that at all.
In a perfect world.
That's right. I've seen about 100%. You have more time to spend money. You have more, I don't go on Amazon.com one time when I'm at work during the week. But on the weekends, I'm on Amazon Prime, baby. I need this, got to have this. You just have time for it. Or I don't play golf while I'm working, right?
And the other school of thought is, I mean, just think about it. Whatever it is you're earning right now, how great would it be if that number continued into retirement? And if you plan right, I mean, it can be done. Unless you haven't saved anything, obviously, but
some people
then there's not much we can do.
I've been doing this 30 years. They say,
not taking any more new clients.
They'll say, I haven't saved anything. I'm 62, about to retire. Well, can you help me? Well, what am I going to do? There's not much you can do. Or I have people that make a lot of money. They might make $400,000 a year, and they go, I need about $250 a year in retirement. And I go, how much have you saved? $500. Well, how am I going to do that?
Yeah, they got the whole their lifestyle takes all the cash.
Oh yeah, I mean it happens a lot. But it'll show you during retirement, but pre-retirement, it'll show you how much extra you have each month. What does it take into account? It takes your income from all sources. It takes your 401k contributions. It takes any other bills you've got. And remember, it'll account for a mortgage payoff, a loan payoff from a car, whatever. It'll do those things and show you how much extra you have a month. And then during retirement, this is the best thing it'll show you. It'll show you how much income you have from pensions, Social Security, also the cost of living adjustments on that Social Security. Your statement you get from Social Security does not have cost of living adjustments on it.
You can't see because it's a radio show, but what Victor's looking at right now is the retirement page, your income. And I wanted to mention to Victor, you know, a lot of times I've found lately, I've been just using that page because it shows it's got your pension page, it's got your expenses on that page, it's got your income, it's got after-tax income, it's got your investment qualified and non-qualified accounts and their balances as it correlates with their ages as they get older. And it's much easier. A lot of times I've given the whole report to somebody, and it's got the pie charts and the everything on it. That page really summarizes it nicely.
And there's a lot of behind this page. There's a lot of things because it takes into account every single month of that year. Because sometimes you'll take Social Security, it'll be mid-year because your birthday falls in a certain thing.
Or you got a bonus at a certain month with your job.
Right.
You want to retire in 5 months
so
instead of a year.
So it'll show you mid-year. It'll also show you, like I said, the Social Security, how much taxes you pay on Social Security. You know, you got 0 to 25,000, you pay no tax on Social Security. From 25 to 34, you pay 50% tax. And then from 34 on, it's 85% taxable, not tax.
Yeah.
Sorry, taxable.
Yeah. Whoa!
That's the next one they're going to do.
We're going to get him out of office.
That's the next. It'll also show you those required minimum distributions. So at your tax rate, they made you take out, say, 5 or 6% out of your retirement accounts. Made you pay tax on it because it was ordinary income for that year. And what did that come out? So what was your net? So it shows you after all of these different sources what your net would be. And that way you're still going to have your expenses. It'll show you the surplus or the shortfall. And it'll add that or subtract that from your account balances. And what that does is shows you with my current strategy, currently what I'm saving, am I going to run out of money? Do I need to save a little bit more? Do I need to cut expenses a little bit? Or can I go with this plan? Because it'll happen no matter what. People always tell me, I remember the old days, you save $1 million, $2 million, oh, you're home free.
Good for life.
It's not anymore.
That was the 60s and 70s, though, Victor. You're showing your age.
It's different now. It doesn't depend on, it doesn't matter how much you save. It depends on how much you spend. You save a couple $1 million, you spend $2,000 a month, you're golden.
My grandfather said it's not what you earn, it's what you save. Was he wrong?
It's probably a combination of the two.
There you go.
Don't hesitate to call us if you'd like to take advantage of our complimentary, no obligation retirement analyzer, stress test, and Social Security optimizer. Our number 972-715-2424, or go to ilovemyretirement.com.
And we are taking new clients.
That's right. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. We're talking about our retirement analyzer, stress test, Social Security optimizer, how they work together. It is so important that you don't wing it when you get within, even in my opinion, 20 years to retirement. You cannot wing it. If you have a plan, you can implement that plan and you'll get there. These people that just gamble all the way and say, I think it'll be fine, and then get there, and it's a rude awakening to what actually happens in retirement. There's a couple different aspects. We're talking about the financial aspect of retirement or the mathematical aspect of it, but there's also a psychological aspect of retirement that you cannot ignore. Because trust me, I don't care how much you've saved. If you retire and that paycheck stops and that market drops in half, it will affect you. I don't care who you are. It will affect you, and you will not be able to just do nothing. Typically, you'll put it all in money markets and just relegated yourself to a slow death. That's just the way everybody is. It's too hard because oh my gosh, at this rate, I'll be broke, 2 years into retirement or 5 years into retirement. I can't take this. Pull it all out. And that's what happens without a plan. With a plan, you can stay the course in those stocks if you want to. You don't have to. Obviously, it's your money. Do whatever you want with it.
And you'll be fine. And a real easy example, I heard it about trying to cross country. If you wanted to leave Dallas and get to the L.A. Coliseum, you could get there without a map. I mean, you'll get there. You probably see it when you get close. But if you had a map, a streamlined course, you can get there in a few days.
That's right.
Exactly. Same thing.
That's right. Also, have you ever planned, if you don't have like I say, the typical wirehouse stockbrokers don't do this. They're not really planning for retirement. They're just trying to manage your money. And they may manage it the exact same way when you're 30 as when you're 60, which is impossible.
Well, they usually do. I don't get it. But
it is what it is. But what if one of your spouses passes away? You lose the lower Social Security. How does that affect your retirement? Those are things you need to put in a plan. And those are things you need.
That brings up a good point. When you have your information plugged in, and we've gone through it, and we've run a couple different scenarios for you, you now have everything pretty much in one place. If something changes, unfortunate, like a spouse dies, or something good, you get a windfall. I couldn't get it out. A windfall of cash. It's real easy for us to make those adjustments, and boom, you can see the new plan.
That's right. The plan is something you can change along the way as conditions dictate. But this is so important, and that's why I'm offering it to my listeners here. This is extremely important. If you have a roadmap to retirement, is the way you get there. You can fall into it, sure, but it's a lot better when you know what's coming. Don't hesitate if you'd like to take advantage of it. 972-715-2424. Again, 972-715-2424.
You can kind of look at us as the Google Maps of retirement. Put in this, and we can show you how to get there. No?
They started doing that stuff. What was that one commercial where they got like a yellow line?
Oh, yeah. I forget the brokerage firm.
I don't know.
Probably Fidelity or something, I'm sure.
It's like you got to follow the line.
Yeah. That goes down the street to the guy's work, and yeah.
Well, let's give you one example. All right, we have a client came in recently that saved about, 1.2 million, something like that.
Qualified, non-qualified?
Mixture.
Got
it.
Right? Got it.
And with their current plan, expenses are a little over $5,000 a month, something like that. With inflation. Without inflation, it looked like they were fine. With inflation, because their bills went up quite a bit over time. I got $5,000 turned into $10,000, $12,000 a month, just with 2.5% inflation. It will happen to everybody. Think about it. Nobody spent $1,500 a month on groceries now like they do now.
Were they retiring early?
No, retiring normal.
All right.
But those expenses kept going up and up and up. And so without inflation, it looked like, this person's fine. $5,000 a month, they got 1.2 million, they're going to be fine. With inflation, it ran out at 92. Now, 92 is pretty doggone good. Or 90, actually, it wasn't 92, it was 89, I'm sorry. At 89, that's not bad.
No.
That is way better than I see probably 90% of the time. Usually, people are shocked to know they're going to run out of money in their 78. I didn't retire until 68. I got to run out 78? Yeah, or maybe 82.
See that a lot.
This one did a little bit longer than that. By taking like 30, 40% of those assets, putting it into a guaranteed income stream, that made all the difference in the world. All right? What it not only did, made sure they wouldn't run out of retirement, they had more money when they retired. They died than they started with, just by taking that. Because what happened was they were spending probably $2,000, $2,500 a month out of their savings, and that was depleting your savings. Instead, we took an income stream, replaced that amount of money, $5,000 a month, okay, with an increasing inflation kind of protected increasing income stream, and it came out where they started with about $1.2 million. They ended with about $1.2 million when they passed away. And so that's what a good retirement is. Your money never goes down.
Yeah, and I've got to highlight that point because it just came out again. It came out March 1st, the one that Victor's talking about. We've got an income stream that if the market goes up when you're in retirement, your income will increase proportionally, and that becomes your new floor. It'll never be lower than that. And if it doesn't go up for a few years, it stays there. If it goes up again, your income goes up. And if you're getting so much income that it does exhaust that account, not your cash accounts, but that income account, you still get the income and it still increases when the market goes up. It looks great on the analyzer.
I mean, see some of these things. Let's say it was 700,000 and you start with 5,000 a month.
Right.
Which, put it in perspective, 700 grand, they're giving you 60 grand a year.
Is that on this example?
Yeah, it's pretty good.
Excellent.
Right? But what happens is every time the indexes go up, you get a raise. And so if it goes up 10%, now your income goes up to 10%, and that's a new floor.
5,500 instead of 5,000.
That's right. And it just keeps going like that. And the best part is if the money runs out. In other words, we're stress testing everything. We want it to do bad. We stress test it, and it runs out. The increases continue throughout your entire lifetime. You could have not had money in there 15 years, and they've given you raises for 15 years. We'll talk about that more when we return for the break, folks. Don't hesitate to call us at 972-715-2424. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Today we've talked about the benefits of having a retirement plan, a written retirement plan that takes into account your taxes, future inflation, future cost of living adjustments on your Social Security, or pensions if you're lucky enough to have those, right?
Yeah, and I don't want to get melodramatic, but it can be life-changing. Certainly retirement-changing.
Oh, yeah. Everybody that wings it, I don't understand. Like I said, it doesn't matter how the money is managed while you're working. It's the day you retire. If you mess up just once, that can wreck your entire retirement.
Yeah, and winging it may be a harsh word. I mean, you'll get there, I'm sure. But what if you could do better, much better?
Well, we showed what if you could put 700,000 in? You start income, you delay income a few years. You start income and you're getting 5,000 a month or 60,000 a year. That goes up every single time the S&P indexes. These are volatility control indexes in this case. Anytime they go up, you get a raise. You could run out of money because we stress tested the portfolio, so you spend it and still get increases 20 years later. I'll show you an example where they started with, remember, 700,000 invested, got 5,000 a month. By the end, they're in their 90s, it was 13,000 a month they're getting.
Started at 5,000.
And they ran out of money 15 years earlier. They ran out of money. So they have no money in there, and they've gone from 5 to 13,000 a month. That's a lot of money on 700 grand.
And I will mention this, and I hesitate, but these programs they're always changing. Different things are happening. If you've listened to us 3 years ago, we had an 8% a year guaranteed security benefit, I think was the company. Did great stuff, and they kept lowering rates, and that's not available anymore. This income increasing retirement for you started about March 1st of this year. In history, if it repeats itself, the rates will lower and things will change. Right now, it is at its peak and will be for a while. We haven't received any emails saying rates are changing. So if you're even quasi-thinking about it, give us a call.
The increasing income is the highest I've seen of anything. Now, you're going to start. There's all the high guarantee products, which we still offer. For those of you that I want the guaranteed, that's still available. No question about it.
But a combination of both is really good.
But if you got one that really attacks inflation at the same time, because remember, 5,000 a month now is good, but it's not going to be worth as much 20 years from now. That 5,000 is not worth 5,000 anymore. And so having an increasing option that increases no matter what happens, is a really, really interesting thing. You start with a little less, but you end up with a whole lot more.
That's a good point. It's kind of like if you take Social Security at 62 opposed to waiting to 70. If you live to 72 or 73, you should have waited, because if you waited a little bit longer, it'll have caught up and made more. Same thing with this. It'll start a little bit lower, but it'll pass the higher paying ones in 6-7 years.
Yeah, remember, this is something for life. It's like a pension. It's like Social Security. It's for life. You got to plan it as such. If you just plan it for the first year, that's what so many people do. We're emotionally attached to our money. We're short-sighted. All we do is, okay, my Social Security is $3,000, my bills are $6,000, I have to take $3,000 out of savings, or I have to replace this $3,000, and that's all they do. They forget inflation, all this other kind of stuff. And we're not like those scare tactics. You know, those are crooks just trying to sell you their agenda. Oh yeah, you better watch out. You don't want, paper money. You want real hard assets.
I put my money in gold.
That's right. All that BS. They're just they got an agenda. They're trying to sell you something. We're going to use like 2.5% inflation. That is reasonable. It's not crazy inflation. People always ask me, what, don't you think we're going to have hyperinflation? Well, not since the government started controlling it. That they've showed a willingness to keep interest rates very low for a long time.
Don't get me started on that.
No, they will not let them go up. They can let them go up, but if you look at any time a CD got around 5 or 6%, they'll beat the Fed funds rate down 15, 20 times, and to cool it off. They didn't used to do that in 1980, 81.
That's right.
When I was in school, I'm telling you, this stuff went crazy. That's when you were getting 15, 18% CDs. But they saw what that did to the economy. That destroyed the economy. It took a long time to recover. Now,
good for retirees, though.
Real good for retirees.
Yeah.
But I think the government has shown that they don't care about retirees.
No, Wall Street, not Main Street.
Yep. They don't care about retirees. They care about the economy moving. In other words, people can buy and sell homes because of lower interest rates. People don't buy a price. They buy a payment. And so that's why the price can come up to meet that payment. That's what people buy. When you have a business and you need a business loan to expand, you can expand. If you had 15% interest rates, you're not expanding. If your price of your house, think about that. If you had 10% interest rates right now, your house would be worth about half what it's worth because that's what the payment would be. People buy payments. They don't buy anything else. That's why you go to a car salesman and they're like, forget what it costs.
Yeah. How much can you afford
monthly?
You
afford to buy?
Yeah.
They might put it in a 20-year payment.
I know, right?
But they're going to fit that. That's the biggest mistake I always tell people. I go, don't you dare tell them the payment. You got to work the other way around. And so that's why it is so important to take advantage of our retirement analyzer, stress test, and Social Security optimizer. It will show you what your life is going to look like 5 years into retirement, 10 years, 15 and 20. It can show you what happens if one of the spouses passes away. How are the expenses going to be to the other one? We can also address things outside of the retirement plans like long-term care. What are you going to do if one of you has to go to a nursing home? It's very rare that a couple goes to a nursing home. One of them does. The other one still has the same bills. Their bills didn't drop off except for maybe food. So you've got to account for all of those different things.
And the good news is we can accept a few more new clients.
That's right. So don't hesitate to call us. If you have any financial questions or would like to take advantage of our no-cost, no-obligation retirement analyzer, stress test, and Social Security optimizer. Our number is 972-715-2424. Our number again, 972-715-2424. You're always welcome to go to our website, ilovemyretirement.com. I'm Victor McClure. For Guy Allert, we always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.